Joining me now is Junaid Bray. Junaid is one of the portfolio managers of the Nedgroup Investments SA Equity Fund. This fund is a concentrated share portfolio selected from the All Share Index through an active fundamental valuation investment process. So Junaid, we saw quite an exceptional rally in SA equities last year off the back of the GNU and all the positive sentiments around it. And as an SA equity fund, we would expect that the fund would have been a great beneficiary of this. So can you talk us through the performance over the last year? What stocks, did really well and maybe some that experienced some challenges?
Sure. So thanks for hosting us, Natalie. I think, if we look at last year, we had quite a strong run up until Q3, especially post the GNU in that couple of months. The last quarter of the year, we did see a bit of a pullback as emerging markets sold off post the US election and the dollar strength that we saw. We saw the rand weaken as well as domestic selling off. So we lost a bit of steam into the last quarter of last year. And I think our fund performance was similar. So we ended the year with about 12.3% against the benchmark of about 13%. So slightly behind the benchmark. And really the last quarter was what hit us. We were ahead before that. And if we drag that across into the longer term performance of the fund, we did about 8% over the last 3 years, about 10% over the last 5 years, and then still comfortably ahead since inception, about 8% per annum versus 7.5% for the peer group and the benchmark. I think something about the consistency of the fund, a stat that we like to look at, which highlights the consistency of outperformance. When we look at the fund performance versus the peer group, as well as the benchmark over rolling 5-year periods, about 2/3 of the time we outperform our peer groups, and about 74% of the time we outperform the benchmark. It gives us a better sense because we will go through periods where we underperform, but I think that gives us a nice indication of the consistency of outperformance. To answer your question about what delivered for us and what didn't deliver for us last year. So definitely last year was a year of domestics outperforming. And you can see that coming through quite nicely in our attribution, where a lot of domestic names had come through. So we had Fushini Group coming through quite nicely. Several of the bank positions we owned in the fund, ABSA, FirstRand, Nedgroup coming through quite nicely. And we also used the opportunity early in the year, just around election time when there was uncertainty. A lot of the domestic sold off, and we used that as an opportunity to add to domestic names like Remgro, Bidvest, and Woolworths, etc. So those all contributed quite nicely, as well as British American Tobacco. After several years of underperformance in 2024, it performed very well. There were some disappointments in the portfolio, as you always have. If I look at the main detractors relative to the benchmark, the 3 names that pop up that we owned. Sasol was one of them, and I think the glut in the petrochemicals market particularly had dragged Sasol down. Anheuser-Busch, particularly in Q3, I think the alcoholic beverages, especially the spirits and the beer category, had underperformed quite a lot in the last while. And Q4 last year, with the dollar strength, 70% of their earnings comes from emerging markets. So it got sold off quite a lot into that. But we continue to hold that. We think it looks exceptionally attractive at these levels. And then Mondi as well, being exposed to the European macro environment and the paper industry there, that got hurt. But the rest of the detractors were really shares that outperformed, that we actually didn't own in the portfolio, the likes of Capitec, some of the retailers, Mr. Price, Truworths, etc.
So let's just go and focus on that SA equity component. As I mentioned, there was a lot of positive sentiment around the GNU, but are we seeing any actual physical change that is actually backing up all this positivity that we've been seeing?
That's a very good question, because clearly I think we all feel a lot better. The sentiment is there, but have we actually seen anything? So I think, the first major one is, I think, load shedding. I think since March last year, we haven't seen load shedding. And I think that in itself is quite a big driver of sustainable growth going forward. And I think we were all skeptical around election time, whether they were keeping, burning more diesel just to keep the lights on. But we're sitting here comfortably with almost a year without any load shedding. So that's great. I think you have seen a lot more interaction and engagement between government and the private sector, something that we were lacking for the last 10 years. and that's come through quite nicely. So I think what needs to happen is a lot more infrastructure investment, because I think we've got a serious infrastructure deficit from what's run down in the last 10, 20 years. So there's a lot of catching up to do, and I think we're starting to see signs on the logistics side. It's not going to be a short-term turnaround, but I think in the next 3 to 5 years you're going to see significant improvements in logistics. I think water infrastructure, I think especially those living inland, water is becoming a big problem, and I think we need a lot of spend there, and I think there are engagements happening to start getting that spend off the ground. And I think, look, some departments, like I think the Department of Home Affairs, I think the Minister's doing great work there in improving the efficiency, getting visas for skilled labour and workers coming back into the country, those sorts of things. I think we are seeing signs of that happening. But I think when you put all of that together, I think there are upside risks to expectations.
So if we can keep this going and keep this momentum of the economic reforms and boost consumer confidence, what could we expect to see? You know, what could the knock-on effect to the economy be of that?
So I think we've come through a period now where we've grown, our economic growth has been so slow for the last 10 years that even when we look forward, I think economists are hesitant to put anything north of 2%. It looks like about 1.7% for this year and maybe 2% for the following year is what is penciled in. I think when we chat to policymakers, Treasury, etc., I think they're earmarking 3%. Now, I think, look, that's quite optimistic, but I think anything north of 2 is well within reach, 2.5. And that's why I think there's quite a lot of upside to economic growth. Now, I think with that comes the multiplier effect of job creation, and a lot of the infrastructure investments does create a lot of jobs as that process gets rolled out. So I think job creation is one thing, and I think, look, where we are cyclically at the moment, I think you will see the benefit of lower interest rates for the consumer, as well as the two-pot withdrawals. I think will be a bit of a short-term feel-good factor and spend factor for some of the retailers.
And Junaid, do you think with this re-rating that we've seen in SA equities, has the market run ahead of itself, or do you think that there's still upside to be seen at these levels?
So we've had that strong rally, as you point out, and I think if we look at the valuations on our local market, so we've had that rally off very extreme lows, and we've actually just mean reverted. That's all that's happened in terms of where we've gotten to with this rally. So we're not expensive. We're actually trading in line with our long-term average of about 10, 11 times, with a lot of upside. If that positive economic backdrop comes through, there's upside risks to earnings, as all companies will benefit from that. Most companies will benefit, domestic-focused companies. And then you've got the upside of higher earnings growth plus a re-rating. So we think SA equities actually look very attractive in this environment.
And how does SA equities look compared to our developed and emerging market peers?
We still, with all of that being said, we're still exceptionally cheap, because I think we've de-rated over time, because I think a lot of emerging market investors or international investors start out looking at economic growth, and we haven't had that for a long time. So I think we've de-rated. We're trading at, if you look at the charts on where our multiples are relative to other emerging markets, and especially we know the US and world markets are a lot more expensive, trading at north of 20 than in the case of the US, but even relative to other emerging markets. And I must say that politically we're actually looking a lot better on the political fundamentals than a lot of the other emerging markets in LATAM, Mexico, for example. And so I think with that backdrop, I think we're trading cheap with upside.
So given your views and all the opportunities out there, how have you positioned the portfolio? And maybe take us through some your thoughts on some of the names that you're holding at the moment.
Sure. So if we look at how we've positioned the portfolio, so the composition of our market, we've obviously got the RAN edges. We're actually seeing still a lot of opportunity there as well. I touched on Anheuser-Busch. I think they're trading exceptionally cheap at the moment. I think the company generates a lot of cash flow. They're busy de-gearing, so you're going to be seeing earnings growth of about 10% going forward with de-gearing and returns to shareholders. Naspers and Prosus, a long-held position in our fund. I think it's currently getting caught in the crosshairs of the geopolitical tensions between China and the US, and we saw that earlier in this month where it got sold off. We still think Tencent is exceptionally strong with the discount that you're getting it in from a nice business process level. And then Bidcorp, a well-diversified food services business. We still like that business quite a lot. It's very defensive and ungeared. Then from an SA Inc. perspective, and this is where we're really excited, most of our exposure is via financials, mainly banks, and we're seeing a lot of upside in FirstRand. They've been pulled back by there's a potential fine and claims in the UK in the UK motor finance business, and that's weighed on the share price. But we're seeing a lot of upside for what is a very good quality, well-run bank, and then some of the insurance names. But then on the SA Inc. in terms of the general industrials and the retailers, we've added to those positions during the course of last year. So TFG has been a long-standing position in the fund. During the uncertainty around the election period, we added to the likes of Remgro, Bidvest. We've added some Woolworths to the fund. So we're seeing a lot of upside in these names, and they're still attractive. Then on the resource exposure, we still like Anglo American, particularly for the copper assets. We think with the greenification, electrification, and data center demand, etc., copper is going to be quite constrained in the next decade, and in excess demand. So we like the copper portfolio as well as the potential bid from BHP. You could see that coming through for those copper assets. And then exposure to gold via Anglo Gold. And we still own Mondi, which is, despite operating in a cyclical industry, it's a very well-run company with good returns and good cash generation. So it's currently in a cyclical downturn, and we continue to hold that position.
So even though this is an SA equity fund, we know that our market's quite sensitive to global crosswinds. What are the global trends and risks that you're seeing at the moment that you think may affect our local market?
So definitely, I think Q4 we saw that coming through as the dollar had strengthened post the Trump win and the tariff wars, etc. So we've seen that the rand blew out, and we could see that quite a lot of our domestic names came off with that sell-off into the last quarter of last year. I think with a Tencent, you could see that with Tencent being added to the US Department of Defense watch list. So it doesn't actually sanction the company or anything. It's been flagged onto that, and we think there's a good chance of Tencent actually getting off that list. There have been many examples of companies proving that they shouldn't be on that list, and they get off. But in the short term, it does create a bit of an overhang. So you could see that coming through. And then I think in terms of some of those crosshairs, I think in terms of the resource impact on the resources and commodity prices, it also impacts our market.
Amazing. Thanks so much, Junaid. We really appreciate your time and all your insights today, and really looking forward to see what happens to the fund this year. I'm sure it's going to be a good one.
Thanks, Natalie. Thanks for the questions, and we're excited about the year ahead.